Morning. My name is Daniel Ogeto, and I'd like to welcome you Personal Investment Webinar. And today we have one of our own, that is Alice Kamau, who is a product and business development lead at Genghis Capital, who is going to take us through the CMA, new CMA guidelines, that is the Capital Market Authority, our regulator, the guidelines that they've set for collective investment schemes. So some housekeeping. Well, Alice is going to present a presentation, and after that, should you have any questions, kindly direct them in the Q&A section down below, or you can also chat us your queries and questions too. Thank you and welcome, Alice, and welcome all. Over to you, Alice.
Thank you, Daniel, for the introduction. As mentioned, my name is Alice. I work for the Genghis Capital in terms of product development. And I'll take you briefly through the new guidelines that were issued by CMA in regards to collective investment schemes. They were issued in September last year in 2020. And mostly the authority noted inconsistencies in the market in terms of how collective investment schemes are run, in terms of reporting investments. And the guidelines are just to fine-tune the market and just ensure comparability and consistencies in the running of collective investment schemes. So I'll take you briefly through a presentation that I have, and as Daniel mentioned, we can have a Q&A session after the presentation. So this is the table of content on what we're going to cover, just basically an introduction to CMA and the collective investment schemes in the Kenyan market, the new guidelines, and just a conclusion. So it's an introduction to capital market, just broadly. Capital markets just brings together lenders, who are people investing capital, and borrowers, which are companies that now issue securities to the lenders, to the public to get capital. So the main function of the capital market is just to bring these two people together, and just for the normal operations of the market. And when you look at the Kenyan capital market, it was established in the year 1989. This was through an act of parliament, and then it was fully constituted in 1990. And just the main purpose of it was just to regulate the capital markets and just to ensure efficient running of the market. And in terms of the products that we have under the capital markets, mainly we have equities, bonds, we have loan stocks and preference shares. We have collective investment schemes, which is what we'll be mostly looking at in this presentation. We have real estate investment trusts. We have asset-backed securities, though I don't think there's any asset-backed security that has been launched in the market yet. We have derivatives, venture capital funds, private equity funds. We have exchange-traded funds. I think this one we saw the first one launched the other day. That's the ABSA New Gold ETF, exchange-traded fund. We also have depository receipts and Islamic finance. These are basically the products that should be there in a capital market. So you find some have been launched, some are still pending and not yet launched in the market. But now the capital market is prepared to offer guidance and regulatory oversight over all these products. So for the purpose of the regulations, in any market, the purpose of regulation is just to maintain and promote fairness, efficiency, competitiveness, transparency, and orderliness within the capital market. It also promotes understanding with the public. This is just to ensure the public understand the products in the capital markets and ensure protection of the investing public, just to regulate the capital markets and ensure that the people who are investing, their funds are safe. It also minimizes crime and misconduct. I think even the CMA has an enforcement arm that goes around the market and just ensure that the market intermediaries are running the market as per the regulations, this to minimize the crime and misconduct. It also oversees the industry to minimize systemic risk, and also it just maintains the stability of the market. So when you look at the collective investment scheme scene in Kenya, it has grown actually tremendously, mostly over the last 3 years. The assets are almost hitting 100 billion, with the statistics as of September 2020 showing the assets standing at 98 billion. And in terms of how they invested, as you can see in the table here, the highest exposure is in government securities at 44%. That's about 43 billion of the assets invested in government securities, followed by fixed deposits at 39.8%. And the least exposure is in immovable properties at around 433 million, representing about 0.4% of the assets under management. And then when you look at the market share of the products that we have, money market funds have the biggest market share at around 87%. So of the 98 billion, 87% of that is in money market funds. This is followed by equity funds at 5.9%. Fixed income funds have about 1.7% market share, and then the other collective investment schemes, like the balance funds, the diversified funds, all the rest make up about 5.4%. So in terms of CMA has guidelines, or they have the collective investment schemes guidelines that stipulate the maximum exposure by mostly the traditional unit trust funds. By traditional, we mean the money market, the equity fund, the balance fund, most of the products that we have in the market right now. So they have if you check, it's on Regulation 78, it has the maximum exposure for each asset, for each security. And they're listed here. We have securities issued by the government of Kenya at 80%, security issued, listed in a security exchange in Kenya, it's also 80%. Immovable property, we're allowed to invest up to 25%. This is of the total assets that you manage. And then you can also invest in other collective investment schemes up to 25%. And you can also invest in any other securities not listed on a security exchange in Kenya. This is where the commercial papers that are not listed fall in. That maximum limit is 25%. And also, if you're looking to invest outside Kenya, offshore exposure is capped at 10%. So this is what is there in just the collective investment scheme guidelines, but the new guidelines we've seen just come in to complement this. So the limits stipulated by the CMAs guidelines still stand, but now they're read together with the new guidelines that have been issued. So we'll go into looking at the guidelines that have been issued. And as I mentioned, they were just mostly to improve consistency in the market and just to also enhance member education to ensure that people investing know exactly what they're investing and the risks that are related to the same. So the first guideline we look at is in relation to money market fund. And here we can see the first one was that money market funds should only invest in interest earning money market instruments that have a maximum weighted tenor of 13 months. This means the portfolio, if I have a money market or fund of 10 billion, the way I balance my portfolio and the securities that I invest in, all of them should have a maximum weighted tenor of 13 months. So initially, what was there is that the CMA did not stipulate the weighted tenor for money market funds. So what happened is that the fund managers who are launching money market funds, they would put this in their trust deeds, depending on the objective of their fund. So you'll see others saying our weighted tenor is 13 months, ours. Another fund might be 20 months. So just depending on the fund manager. So there was no consistency on the tenor of money market funds. They say you invest in short-term instruments, but short-term is also relative to different fund managers. So this guideline has just come to to ensure that the money market funds are almost run at the same way, and just to ensure the comparability of all the funds in the market. And another guideline was that money markets can invest in credit rated or approved commercial papers or public papers, government securities, and fixed deposits. So the change here also is that now when you want to invest in a commercial paper, it has to be rated by a rating agency that has been approved by authority, or if it's not rated, it has to be approved by CMA. So initially, this was not there. A private institution would float commercial papers, reach out to fund managers. If you evaluate as a fund manager and it's a viable investment, you just invest. So it didn't have to be rated. But now we've seen this new guideline. I think it's mostly to improve protection of the members' funds, just to ensure that you're investing in safer instruments, just to protect the funds of the investing public. And the impact of this is that we might start seeing lower returns by money market funds. This is because for the commercial papers to be rated, it means they'll incur an extra cost to get for the rating, and an extra cost might mean they'll have to start reducing the rate that they're offering the return, because they're incurring more expenses. And also the restriction on the tenor to maturity of 13 months, it would mean you'll have to invest in short-term instruments. And when you compare, even when you look at the bonds, longer dated papers have better returns than shorter dated papers. So this effect can lead to, yes, reduced returns by money market funds, but also at the same time, it will increase the protection of unit holders, but just by ensuring money market funds invest in rated papers. Yeah. So that's the guideline that was there in relation to money market funds. We can move to equity funds. So here the guideline was just it directed fund managers to invest a minimum of 60% of their AUM in equity funds, in equities, and all the other AUM will go to cash and cash equivalents. So the change here is that initially, the guidelines here, these guidelines that just showed the maximum limit for any traditional collective investment scheme. So I could have an equity fund and I decide I'm going to invest only 50% in equities. I can do another 20% in, let's say, bank deposit, or I can do even these commercial papers. So there were no guidelines per se, but now this one, it just makes sure an equity fund is an equity fund. So you invest minimum is 60%, but then the maximum you'll have to refer back to the CIS regulation, which capped it at 80%. So any equity fund, a minimum of 60% of its AUM has to be in equities, and the remainder is invested in cash and cash equivalents. So you won't see an equity fund investing in bonds. And I think the main aim of this is just to foster alignment in the industry and just ensure all the equity funds are run the same way, and just for an equity fund to be an equity fund. So for fixed income funds, it was similar to the equity fund, where it stipulated that a minimum of 60% of its assets under management has to be invested in fixed income securities. And everything else that's not invested in the fixed income security has to go to cash and cash equivalents. So initially, similar to equity funds, there was no stipulation of minimum percentage. But now this one also, again, the impact is just to foster alignment for all the fixed income funds in the industry. So for balanced fund, so a balanced fund is basically like a mixture between a money market and an equity fund. So here the guidelines just said that, so the maximum exposure, if you have a balanced fund, the maximum exposure into equities, so the AUM in the balanced fund, you can invest up to 60% in either equities, fixed income securities, or money market. And then the remaining can be invested in the other assets, that is the commercial papers, the offshore, but to the limit that is stipulated by the CIS guidelines. So if you have a balanced fund, you can't go investing 65% in equities. Equities, you can only invest up to 60%. Same way, you can't go investing more than 60% in money market instruments or fixed income instruments. So here you have to balance your portfolio, just ensure it has an aspect of equity fund, of equity investment in it, an aspect of money market instruments, fixed income securities, just to have a balanced portfolio. Also, the impact, similar to the other two, is just to foster alignment of all the balance funds in the industry. So there are also other guidelines in relation to specialized funds. So CMA has guidelines that allow fund managers to structure a product that suits their set objective. It can be a product that targets a specific clientele. It can be a product that maybe invest in a specific sector. So for these funds, CMA, the guideline was just to stipulate that the IM should clearly outline the strategy of the fund, and then CMA will approve this on a case-by-case basis. So the impact on this, we see the increased registration of specialized funds, because if you see the traditional collective investment scheme, they're very tight in terms of investment, where you can invest the limits that you can set. But now, as a fund manager, if you have, you're at liberty to structure your own fund that will have the exposure depending on the objectives that you want to attain. So once you formulate this, when you structure this product, you take it to the regulator, they evaluate, they put measures to ensure that with the product that you have should target these people, this clientele. What are the minimums that you should put? What are the disclosures and the risk disclosures that you should inform the investors? So, and then they'll approve this product. So the fund manager here has more liberty on the limits that they should have in terms of exposure. You can have a real estate fund that you can say, I want my fund to invest even up to, let's say, 40% in real estate, as opposed to the 25% stipulated in the CMAs guidelines. So I think we'll start seeing more registration of specialized funds, as now this one will give fund managers more leeway into structuring a product that best suits their investment, their objectives. So another guideline was in the naming of funds and basically investor information. Just this one stated that the fund should include the generic name of the relevant fund. If it's a money market fund, you need to have a money market fund in your naming. It can be whatever the name of the fund manager, but it must have the name money market fund there, just to carry the generic name of the fund. And then for specialized funds, the name just ought to describe the characteristics of the fund. So if you have a fund that you want, it may be for home ownership, it will be whatever, maybe Genghis home ownership fund, or if it's investing maybe in let's say financial services, it should be XXX Financial Services Fund, just to describe the characteristics of the fund. Another guideline in terms of investor information was that the fund manager will provide the approved information memorandum and a list of all the funds they're offering on its website or any other medium that is accessible to the current client or the prospective client. So initially, this was not a requirement, and I'm so sure even if you ask most of the investors in, let's say, the money market funds, equity fund, the normal collective investment scheme, they've never seen the information memorandum of the product they're investing in. And the information memorandum just basically gives you the structure of the fund. It says it highlights the fees chargeable by the fund. So when you go through the information memorandum, you'll see in details all the fees that are chargeable by the fund. It also shows the risk of the fund and how the fund manager aims to mitigate the risks that are there. So it's a very important document for the investor, just to learn about the fund that you're investing in, so that just to ensure that you're making an informed decision when you go to invest. So this one will just enhance member education and just give more information to the investors and just empower them when they're making investment decisions. So the other guideline was in relation to performance reporting. So here, the guideline was the returns for when you report returns that are for a period less than 1 year, you're not supposed to annualize them. So if I'm reporting returns for the last 6 months, you don't say annualized, then you multiply by 2 and you say the annualized return is this. You just report for that period. And also for the fund managers, they have to report returns that are net of all fees. So fund managers report returns. The returns are published in the newspapers. So if you want to see how your money market fund is performing, all you need to do is just buy the newspaper, and there's a section where it publishes the returns by the collective investment schemes. So here, I think this one is just mainly to standardize reporting and level the field for all fund managers and ensure fair competition. Because you see, there was no guideline. You'll see this fund manager reports fees that is net of all fees, but gross of tax. But another fund manager still with the same product will report maybe returns that are gross of fees and gross of taxes. So you see, it's not fair. It's not fair competition because a return might be high, but you're not told that we have not deducted the fee. So this one will just ensure fair competition, and also when investors, when they see the return, they'll know all the fees have been deducted, and maybe all they'll have to pay is taxes, which is usually holding 15%. But it's also dependent on the client, because you'll find some maybe clients or institutions that are tax exempt. So for taxation, this one is specific to the client, but the report has to be net of all fees. This is standard for the whole fund. So the other guideline was in relation to advertising and the marketing materials that are issued out there by collective investment schemes. So it stated that for all publication, the fund managers will include the minimum net asset value, and for the yield, you'll include the month. If I'm reporting, for example, for February, it will include the month to date yield, the quarter to date, that is now for Q1, and also the year to date yield. Also, you're supposed to show the highest and the lowest price or yield. So some collective investment scheme will give price, the others will give yield. So you're also supposed to show the highest and the lowest for the last 1 year. You're also supposed to show returns according to at least 1 year, 3 year, and 5 year annualized returns. So if I'm showing for my fund, I'll show returns for the last 1 year, the last 3 years, and the last 5 years annualized. This is just to give investors a view of how the fund has been performing, historical performance. And you're also supposed to disclose all the fees that are chargeable to that fund, including performance-based fees. So you might not know, maybe your fund is charging an X% on outperformance. So this is also to just give more education and disclosures to the public, just to enhance more understanding of the product. And this is also just mostly to boost confidence in the industry, because you might find maybe a return is so high, but no disclosures on what will be deducted before you actually get the net return that will go to the investor. Yeah, so that was basically it in terms of the recap of the guidelines that were issued. And so in conclusion, we see the new guidelines will improve actually the collective investment scheme market in terms of improved investor confidence, given that the investing public is more empowered, more informed about the products that are there, how they're run, and how the performance also, and also just give them access to material that will allow them to learn more about the product and enhance member education. It will also foster fair competition among fund managers in that the limits really stipulate how you're supposed to report on performance, how you're supposed to invest, depending on the product that you have, be it equity fund, money market fund, or those funds. And it will also, we see it paving way for more innovation. We see fund managers coming up with more diverse products out of the traditional collective investment scheme that will now target different clientele, target different sectors, just to meet their investment objectives. And we are also, as I mentioned, seeing improved member education, and just to ensure they're more empowered when investing in the money markets, in the equity funds, the balance fund, just basically all the collective investment schemes. So that was the brief presentation. I think now we can go to Q&A. Thank you.
Okay, thank you very much, Alice, for the nice presentation. And now we go to the Q&A section where we have two questions. Anis Saitua is asking, when do these regulations take effect?
So the regulation took effect as of 1st of January 2021.
Okay. And then Bernard Onsongo is asking, most funds are not publishing the financial statements in time. Is there a regulation in place to force disclosure of information on different funds?
So we saw initially the funds were supposed to publish twice after the full year, that is by 31st of March every year, and after the half year, that they're supposed to publish 2 months after the half year, that is by August. But we saw, I think last year, the CMA lifted this after the coronavirus, and they were now supposed to have the performance and their financials on their websites. So if you don't see them published on the newspapers, try check the websites for the different fund managers that have collective investment schemes, because the financials will be there.
Okay, thank you, Alice, for that. Ziki Odote is asking, will we receive information on the Hela Imara Fund, or is it already posted somewhere? Well, Ziki, what we usually do is that we have a Genghis Fund fact sheet, which is produced every month, at the start of every month, that is highlighting the previous month, and is usually posted in the website, in Genghis Capital's website. So maybe you can share with you the link. You can be seeing the fund fact sheet for the previous month and the other months. Ezra Kanani is asking, have you witnessed a decline in money market rates since the regulation took effect? Alice?
For this, for the portfolio that you have, maybe they have not started decreasing of yet, because, for example, in the commercial papers that you've invested, the guidelines will give you leeway until maturity of that investment. So if by, let's say, December invested in a 6-month paper, it does not mean by 1st of January I have to recall that investment and now invest in a rated paper. So CMA will allow that to run its course until maturity, but now when you invest upon maturity, it will be in a rated paper, which most likely will have maybe a lower return. So as of yet, the effect is still, it's gradual. It won't be just one-off. So but as now the portfolios mature on where you have invested, now as you reinvest, they have to be in line with the new regulations.
Okay, I think you've also answered David Ngugi's question, which was on regulation 2. Arwin's Rota is asking, on commercial papers, will the rating and approval by CMA both apply to one option, or one can substitute the other?
It's either or. So it has to be rated or approved by CMA.
Okay, thank you very much. Ann Mudhoni is asking, given that new guidelines stipulate that money market funds should invest in interest-bearing assets, which are weighted averages of 13 months, how will this affect the previous securities invested in? Simply asked, say the fund has bonds with a weighted average tenor of more than 13 months. Will the fund sell the bonds to be compliant, or does this affect any new investment after January 2021?
So as I mentioned, there's leeway, especially for the previous investment. So if you had invested in a paper that matures in, let's say, 2 years, you're not supposed to sell this paper. But what fund managers now will have to do, so the weighted tenor is for the whole fund. So you can invest in a bond. If you have a bond that was 5 years, it means the other investment will be very short term, 3 months, maybe even 6 months, just to bring down the overall weighted tenor of the fund. So you might have a bond that is 5 years, but now you also have maybe another AUM, maybe even like 50% in very short-term instrument, let's say even 3 months fixed deposits. So that when you calculate the tenor of the fund, it comes down to those 13 months. So what will happen is gradually fund managers will start reducing the tenor. It's not, I think CMA will gives just leeway, because as now the portfolios mature, the securities mature, you will invest according to the guidelines, and that will now go gradually reducing the tenor to the stipulated time. So what you're seeing mostly is if you have long dated papers that you can't exit, it's either you exit and invest in shorter dated instruments, or if you can't, you have to rebalance your portfolio by maybe all the inflows you invest in very short-term instruments just to bring down the tenor to the stipulated by the new regulations.
So in this year, we are going to see most money market funds being reorganizing their investments.
Their portfolios, yeah.
Their portfolios, yes. Sorry.
Yeah.
So maybe I can go through some of the comments that have come in. Patricia has asked, what is the current rate of the GenCap Hela Imara money market fund? So currently we are 10.02%. That is net of management fees and gross of withholding tax. And where can we find the fund fact sheet? The fund fact sheet can actually be found on the website under the Unit Trust Funds page. That is the Genghis Capital website. Let me go through other questions that have already been answered. Samuel Nyangi was asking, what are some of the special funds in the markets? So these are the normal money market funds. There's the balanced funds, the equity and fixed income funds. And I also had a question. Wait, I think I've seen
special. Let me just see the question. Sorry.
What are some of the special funds in the market currently? So
in terms of the specialized funds, I think currently we have a few by Saiton. There's a financial services fund. There's also a high yield fund, I think, that invests in real estate. As Genghis, we're also looking to bring several to the market. I think by end of Q2, we're working on, actually, I think it would be the first an index tracker fund. We're also working on financial services fund. So we're also looking to bring several in the market. There are not many as of now.
Okay, thank you very much. Shalin Dunge was asked what's the allowable exposure, and the answer was wait, this is the maximum % exposure. Okay, thank you. I can see the answer has already been answered. There's one. Bernard Onsongo is asking, does Genghis have any specialized fund?
I think I have responded to that. We are working on bringing launching, I think, about 2 in Q2 this year.
Okay. So there being no question, I'd like maybe to encourage you that the main reason of us going through this CMA regulations is so that you get to know the kind of funds that you're going to invest in, and the profile and the risks involved. And also there's that confidence that comes in when you know that whatever you're investing in is solid, and the results, or rather the interest that comes in is what you are actually sold to in the first place. So currently you can invest in the Genghis GenCap Hela Imara Money Market Fund, which is run by Genghis Capital. And if you'd want to register, maybe you can register via our application called Jikuze. Just download it from the Apple or the Apple Store or the Google Play Store, and then register, and you're good to go. You'll start investing. We also have, to encourage consistency in saving, we also have, we can say it's a sub-product of the GenCap Hela Imara. It's called the Haba Challenge. So this challenge is the 52-week saving challenge, which is it is geared in enabling you to save all through the 52 weeks of the year, and this money is invested in the GenCap Hela Imara Money Market Fund. And at the end of the year, or rather at the end of your 52 weeks savings, you're able to get your money plus the interest, and which compounds daily. So I don't know, Alice, whether you have something to close.
I think there's one question that came in from, I think, Daniel Nderitu. He's saying, I'm a bit lost. So if I have a 10-year bond, I need to sell and get 13 months short-term investment. As I mentioned, if you're a fund manager, you had invested in a 10-year bond. So the 13 months does not mean all instruments that you have to invest in have to have the maximum tenor is 13 months. The maximum tenor is for the whole portfolio. So if you had a 10-year bond, you can retain the 10-year bond, but then it means, okay, what percentage of the bond? First, you have to ask yourself what percentage of the bond, the investment in the bond is in relation to the whole portfolio, because it would mean you can keep the 10-year bond, but then the other investment will be very short-term investment to bring down this 10-year. Because you see, this 10 is already a very long duration exposure, a long-time exposure on your portfolio. So you can invest in the other AUM, you can invest in very short-term papers, so that when you calculate the tenor now for the whole fund, including this 10-year, it will have been brought down by the other short-term investment, maybe to those 13 months. So it depends. If maybe if the 10-year is more like maybe than 50% of your portfolio, you might need to sell it. But if it's maybe, you'll see it's maybe 10% of the portfolio, the other 90% can be in very shorter term, so that when you calculate the tenor now for the whole fund, it brings it down to the stipulated limit.
Okay, thank you very much, Alice. Some questions have also come in. One from Abdirahman Abubakar, who is asking for us to share the video. Well, a copy of this video and other videos will be available on our YouTube page. Just go to YouTube and search Genghis Capital Limited, and you'll be able to find a link that will give you this and other videos. And then Jane Mwenja is asking, at what point do I need a CDS account? Well, when investing in unit trust and in unit trust products, you do not need a CDS account. All you need is just register, and then you'll be given a member number, and then you'll be good to go. Peter Maina is also asking, he has an issue with Jikuze, where he's depositing money, and then it takes days before he can invest it. Well, when you invest, or rather when you put money into a unit trust, the money is deployed right from the next day. So it will start earning right from the next day. And then Dorcas Mwangi, a copy of this video will be available on the YouTube page, as I've said before. And then Beryl Onyango is asking, what is the interest on the Haba Haba challenge? Well, the interest is tied to the asset to which that money is invested into, and the product, sorry. And this product is the GenCap Hela Imara Money Market Fund. And if you are investing, say your 52 weeks are closing today, or rather are coming to an end today, that whole money will have had an interest of 10.02%. That is the yield for today for the GenCap Hela Imara Money Market Fund. Yeah, I think that's it from the questions side, and maybe closing remarks, Alice, so that we can wind this up.
Okay, maybe to say thank you for tuning in, and CMA is there to protect the investors. So more than the capital markets, more than just returns. Yeah, it gives you an avenue to save, to just ensure your money does not lie just in the bank, maybe not earning anything. But more than the return, the CMA is there to protect the member. I think most of the regulations that are done, that have been issued, is just to ensure empowerment of the investing public. Just more disclosures by the fund managers, give more ensure members just have all the information they need when making investment decisions. This is a very good move. Maybe the returns might reduce, but in the long run, it's just for the benefit of the members and for the protection and just ensure the growth of the capital markets. So I think it's a very positive move by the capital markets. They're out there observing the market, how it's run every day, and just ensure that the products that are there, they'll meet the investment objectives of the members. They'll ensure safe avenue for you to save your funds, and just know that there's someone looking after your investment. So as an investor, if you have a fund, just go to the website, reach out to your fund manager, get the information memorandum, understand the product you're investing in. I think member education and empowerment is very important. So just be in charge of your own financial decisions. So thank you.
Okay, thank you very much, Alice. And the whole idea is that to have you invest in assets that you're confident in, just as Alice has said, and knowing where your money is going and what to expect at the end of your investment period. So from us at Genghis, we're glad and we are ready to serve you. And should you want to open an account, Genghis is the right choice. So let's meet again in a month's time for another episode of the Genghis Personal Investment Webinar. You can reach us via mail at info@genghis-capital.com. And thank you very much for attending. See you next time.